Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors. Today is April 17th, just after the close. Made it into the office today. Great to be back in the office. You don't usually think of it that way, being able to not wait to get to the office, but it was nice to be out today. The Moose was in the office as well. Good to see him. Good to see a couple of our employees. Another strong week in the equity markets. Took me a little bit by surprise. Thought we'd see some backing and filling this week after the 3-week rally. And started to. Midweek, we started to see some softness, but the futures shot up overnight about 6 o'clock off of that Gilead news on their experimental drug. So we'll see if that gets some legs. Certainly, we'd love to see that from the standpoint of the COVID-19 scenario. Equity-wise, still large cap. Today, Friday, large cap for the first time in a couple of weeks, showing some weakness versus small and mid. And tech and so forth was weak versus some of the banks. Energy up 10%. Not enough to get us overly excited to reallocate that way. But we certainly have that discussion. As you know, we are tilted large cap and tilted towards growth. But we can't ignore the fact that we are at historic spreads in both performance and relative strength in large cap versus small and mid. To ignore that is lazy on our part. So we continue to try to look and see if we see any sign of life, green shoots as they're known in the relative strength charts. Do we start to see any kind of outperformance from small and mid? Obviously, nowhere near that right now, but it is a constant source of discussion. Dating back to the video at the end of 19, where I put up the performance charts of small versus mid versus large from 2000 through 2010, and how stark a difference it was from 2011 through 20, through 19 at the time. The outperformance of mid cap versus large cap was shocking. As shocking as today, the large cap over mid and small. What we have to at least pay respect to is this next decade probably won't be a carbon copy of the past 10 years. So we want to acknowledge that we need to be flexible, we need to be open-minded. The enemy of a trader, the enemy of an investor is narrow-minded and being sure of yourself. Being absolutely sure of your positions, being absolutely sure of what you think is going to happen 3 and 6 and 9 and 10 and 12 months out, never mind 3 and 4 years out. So I just bring that up because I have conversations with people daily that are very sure of how they're positioned, very sure of how this is going to work out in the market. And I want to push back on that because flexibility is king in the equity markets, and especially today when we're looking at a virus that shut down our economy that we really weren't even talking about 3 and 4 months ago. So that flexibility is a key to allocating capital where it can be best served. And we try to do that through our meetings. We try to do that through our strategies. Awfully nice to see the performance we've seen in large cap, specifically tech, specifically healthcare, our largest allocation in U.S. ETF strategy. That's been nice. It's been nice to get air back in that balloon. Really wonderful performance. But we have to respect that trades can become crowded. And to ignore that is to ignore a risk factor that we need to keep front and center. So we'll still keep doing work on that relative strength on small and mid versus large, and I'll keep you informed of what we're finding. So I want everyone to have a great weekend. We're trying to keep it short today. We will try to get midweek next week on with another video, and answer any thoughts or questions you may have. Please reach out if there's anything we touch on that you'd like to discuss further. Have a great weekend.
Hi, it's John Mousseau. I'm the President and CEO of Cumberland Advisors. It's a little after the close on Friday. This week in bonds, not much in treasuries. 10-year bond yields down about 6-7 ticks to 0.65. The real story is liquidity in other markets, and that all follows from last Friday's Fed announcement. So very good reception for corporate deals, very good reception for municipal deals. If you remember last week, the Fed stepped in, putting $500 billion, into municipal notes. That's going to help cure up municipal funding as we come out of this mess. That leaked over into the general municipal bond market. We haven't seen that much issuance yet. That's to come next week when the calendar really picks up. So we'll have a pretty good measurement of how liquid the market is with the amount of deals that are coming next week. But there's no question that deals are coming and getting well oversubscribed, which tells you the liquidity that was missing in the middle of March during the sell-off has returned to the muni market. So we're very constructive from that standpoint. Corporate side, corporate's getting very good bids. Remember, the Fed also stepped in and will start to buy corporate bonds down to and including non-investment grade for those bonds that fell off the wagon, if you will, after the pandemic hit and they saw their ratings go to below investment grade. It does not include bonds that were already toxic or very below investment grade before this happened. So really the investment grade market in both tax-free and taxable bonds has had a very good couple of weeks, but particularly this week in terms of having stable markets, which is the one thing that was really missing in March. So from our standpoint, munis still cheap relative to treasuries. Think about a 125 to 130 long treasury bond versus still lots of intermediate and longer muni bonds at 2.5 to 3. So we expect that gap to continue to narrow over time. Maybe treasury yields move up a little bit over time and yields on everything else move down. That's the way we're thinking. We hope we get good news going forward, not only for a possible cure, possible vaccine, but also certainly as we come out of the stay-at-home mode that we've been in. I hope you all have a great weekend, and we hope for a good week next week. Thanks a lot.